Welcome to the Veterinary Business Institute's annual expert panel webinar series, and this webinar is with our practice transition expert panel, who you can see we have with us three experts that are going to be speaking on a lot of interesting topics today. But specific, this event is about bringing together leading experts in the veterinary practice transitions to help you navigate the complexities of buying, selling, and merging practices in today's dynamic market. We are so grateful for you to be with us here tonight as a participant. Looking forward to a wonderful hour. And I know that our panel will explore the critical elements of successful practice transition, offering expert advice on how to maximize value, overcome challenges, and future-proof, I love that term, future-proof your practice. Now, whether you're considering selling, buying, or merging your practice, this session will provide you with actionable insights. Always important that we can get you something that you can take away and you can put into practice right away. Something that's not just a thought or an idea that gets shelved, but something you can go ahead and be intentional with. So this session will provide you with actionable insights and strategies to ensure a smooth and successful transition. And that is quite often for any of us who have been through mergers or transactions, as I have, very seldom do they look like that. So this is going to be great for us. But let me go ahead and welcome our panelists for this webinar. So it's Kamala Bailey, Sang Part, and Melissa Edwards. Great to have you, three of you, with us tonight.
Thank you.
Thank you.
And I'm going to start off with Kamala with a question. The first question we've kind of got lined up here, I think makes sense to launch us. And it's Kamala, what are the most significant market trends currently impacting veterinary practice transitions, and how should owners adapt to these changes?
Well, an obvious one is the increasing consolidation through corporate entities and private equity. This trend has offered potentially higher multiples than we've ever seen in the past. However, the problem with it is their interest has typically been limited to higher profit practices with multiple doctors who are located in suburban and urban areas. If you fit that demographic, good for you, and you will most likely have multiple offers to choose from. However, if your practice doesn't fit that mold, then you need to start planning now. And I am going to discuss a little bit later what brings value to your practice and what you should do in order to be of interest to individual buyers if you don't fit the mold that the corporate consolidators have. Another trend that's happening, and it's always happening truly, is adopting new technology. Keeping up with what's going on and what your clients want is important. For example, consider using cloud-based practice software. That's not necessarily new, but you'd be surprised how many practices out there have not necessarily transitioned to cloud-based. Some of the capabilities that it has include paperless medical records. That's a biggie when it comes to selling your practice. Appointment scheduling, inventory tracking, and integration with your online pharmacy, integration with in-clinic diagnostic equipment and external labs. Wow, can you imagine that? And then two-way client communications. Imagine the time savings you could achieve if you use your software to its fullest. Granted, it takes time to learn it, but it's well worth it. Some other ideas. Think about your clients. They like to look at the web and they want convenience. Maybe online scheduling would work for you. And if you don't have an online pharmacy, should you consider it? Dictation software. I know the doctors seem to love that. Maybe investing in dictation software, laser therapy, using artificial intelligence. The practice of veterinary medicine is changing, as are your clients' expectations, so don't fall behind. Investing in the success of your practice will make it more valuable. And lastly, the workforce dynamics continue to be a significant factor in hospitals, as well as how they relate to your transitions. We've all heard the horror stories about deals falling through because associates leave. You don't want to be that. Unfortunately, there's no short-term fix to this problem, but if you are struggling to hire or retain employees, then consider these strategies. First and foremost, pay. competitive compensation and benefits. That's huge. Consider as there become more and more women in the profession, I think this is an important one. You should consider flexible work environments, such as part-time roles that support work-life balance. More women means more babies and time off. So maybe instead of having 2 full-time vets, you find 2 mothers that want to share a full-time position. Just some ideas. Another idea is to invest in your team. That's really important. Offer them CE, offer them a chance to advance, offer them mentorship. And if you can focus on well-being, fostering a supportive workplace, and implementing wellness programs, you're going to end up with long-term skilled staff and a great culture where people are happy to come to work. And imagine what that's worth when it comes time to sell your practice.
Pamela, thank you very much. As I kind of hear what you're saying if I was to sum up from my perspective, I heard that relationships are king, and we need to be really intentional with investing in them and protecting them internally with our team, but also externally with our clients, and utilizing some of the platforms that are available for us that can help us just be able to build sustainable relationships, and relationships that actually generate referrals and return sales and all those kind of good things. But it seems that there's just the challenge, I think, is things happen so quickly and are moving so quickly but maybe is there anything that if you were to say to someone, they're going to prioritize something specific they could do, what would be the kind of the top line thing that you would suggest?
I would take a look at probably improving your team, because that would, if you're able to train your team better, make sure that you don't have a lot of turnover, that's going to help increase your profitability and efficiency overall, which in the long run will increase the value of your practice. So investing in your team, I think, is very, very important.
Thanks, Kelma. Sang, I'm going to go to you next. And Sang, for those looking to buy their first veterinary practice, what steps should they take to ensure they're making a sound investment?
The way I would think about this question is to picture a timeline with just 2 points. You have a start and an end. In the start, I would characterize as the current state of the practice that you're planning to acquire, right? And maybe I should qualify that the hospital that you're thinking of buying is not an associate buy-in, a de novo, but essentially you're wanting to buy an independent practice outright, right? And in that scenario, high level, I would look at the first point being the current state of that practice, and equally important, where do you want it to go, right? The future state, right? For the current state, you got to do the basics. You got to do the fundamental due diligence, right? You got to do the financial analysis. You got to review the real estate and market analysis, client staff assessment, assessing your competition in that area, legal and local compliance, taking stock of the physical plant, the equipment, all of those basic things. And I think for the most part, most buyers have an understanding of that current state, right? They understand that they got to do that. I think where most drop the ball is that second point, that future state, right? Whether it's because they've gone through this long process of buying a practice and get caught up in the sort of the day-to-day of being an owner. I think for many people, at some point, they drop the ball and they don't execute on that future state, right? What is the plan for that future state? What are you going to add, right? What are you going to subtract, right? What's it going to look like in 5 years? What's the plan to get you there? What's it going to look like in 10 years? How does the exit look like? I mean, it seems strange to suggest that you need to think about the exit as you're anticipating buying a practice. But in my mind, you need to have a high level view of what that exit is going to look like. So yeah, I kind of think if you look at it high level into those two sort of timelines, current state and future state, it kind of frames the process in a way that I think most of us can relate. What I will probably add is that current state, you're paying, you're going to pay for that hospital based on the current state of the hospital, but really you're buying for the future opportunity, right? And if the future opportunity, if that math doesn't equate, then you got to really think about why you're getting into the calculus of that current state. So yeah.
Sandy, thank you. That's something I heard there. It's kind of like when you're looking at that future state, it's like we don't want to just look at what we do and how we do it, but when we look down the road, we also want to look at who we are and why we matter. Now, what is that overall value that we are passionate about by even going in and buying one of these things? How are we going to translate that into future currency, economically, personally, socially, emotionally, all those kind of things? And I was just curious, do you find that in that due diligence process is social media review a big deal of that as well these days, as far as positive comments or negative comments? Or
Absolutely, it is. It is. So in my past history, right, when I was at VCA and MBA, and I'm doing practice valuations, it was not a direct variable in the valuation itself, but it was an important piece that I would check off, right? Meaning, let's say, Google reviews, Yelp reviews, I would always look at them, right? And the expectation is that for the most part, the veterinary hospitals are going to have positive reviews, right? So I've never taken an assessment of the social media reviews and increased the multiple, increased the value of the hospital. However, I have brought it down. I've taken a turn down or a full multiple down based on the fact that there are enough reviews that lend itself to give me some pause, basically, right? And in certain cases, I would print it out and, present it in the deal review with the business development team and the acquisition group, all the players, stakeholders, and add that in as a variable in the valuation, right? But it's a subjective component. It's not
Sure.
like the quantitative financial analysis, which is usually the backbone of evaluation, right? This here is more subjective. And so it's not as black and white. Hopefully I answered your question.
yes, saying you did actually. And as I asked that question, a question came up from Song Jun Lim just about what would you look at in future status for practice to assess that, which obviously we just talked about social media, but we may be circling back to that as we unpack some of these other questions. So let me go ahead and get Melissa in the game here. Melissa, I got a question for you. What are the critical cultural and operational considerations when buying a practice?
Yeah, hi. And just to follow up on what Sang was just saying, anytime I represent a buyer and we successfully close on a transaction, I say, look, you got the keys to the castle now. Today's the day that you start thinking about your exit strategy, right? And typically, these guys are in their late 20s, early 30s. They've got a long runway, but hey, you never know what's going to happen, right? So I totally agree with what he said. So as far as, the cultural and operational critical pieces of buying a practice, so deciding, you've got a whole marketplace of practices for sale right now. I think that there's a lot of solo practices for sale throughout the country. How do you decide which one you're going to go for? Is it strictly financial? yeah, financial is, should be really number one and potential, right? But you also want to look at fit. And when we look at whether or not it's a good transaction, you could be a great future owner and the practice could be a thriving practice, but sometimes there's just not a fit, right? And so what we really look at is, is this practice, first of all, really similar to the kind of medicine that you practice? We've seen transitions where, you go in and you purchase a practice that's thriving, but you find out when you do your due diligence that, well, it's because the owner does a lot of surgeries. They might not be boarded, but they're doing a ton of surgeries. And so you want to make sure that your medicine and the way that you like to practice is very similar to the one that you're purchasing. But also you're going to look at personalities. If your personality is very different than the existing owner, how is that going to affect the staff during transition, right? A type A going into a type B's practice, that might be a little bit of a rub for the staff, right? So that's definitely something to consider. Also, the staffing in particular, do they have it staffed the way that you would staff a practice? Okay, and where I see a lot of transition risk sometimes is going into a practice where the owner or the owner's family, so like a spouse, they're wearing a million hats, right? And so you look at maybe the financials of the practice and it looks like a lean, mean operation. There's a lot of profit in it, but you find out that the owner, producer, seller is producing twice as much as you feel comfortable producing, right? And they open up on the weekends, and they take clients past closing. And that's just not the way that you want to practice medicine, right? It doesn't mean that's a bad practice, right? But it might not be the right fit for you, or you certainly won't be able to extract the same cash flow from that type of a practice.
Thanks, Melissa. Yeah, that you brought up something. You mentioned something about staffing your practice and how you'd want to staff it. And I'm just thinking here, if I've got some folks online going to say, "Well, that's a good question. I don't know how to staff my practice." We're not going to get into that tonight. That's not where we want to go. But I can assure you that some of those the podcasts that we have on the Veterinary Business Institute address some of those direct kind of questions, like, so what kind of things would I look at to consider if I'm staffing a practice from the out of the gate? What does that look like? What is the best practice? And so I encourage you to have a look at that without going down too far a rabbit trail down that one. But when I hear that the uniqueness of people, we are, on the best day, there's only a small percentage that are very, very similar. And to be intentional with really looking at what it is that, and I don't know if this makes sense to you guys, but I see quite often people haven't done their own due diligence about really their own hardwiring and how they see themselves and how they're seen. So let's go back to Kamala, and I have a question for you, Kamala, that in your experience, how do economic shifts such as inflation or interest rate fluctuations influence the buying and selling of veterinary practices? Ooh, we're giving you the long ones, aren't we?
Well, I'm going to share that. I think the impact of economic uncertainty is huge. And I was actually on vacation in Africa when the election was happening. And I have to tell you, I was kind of glad I was. We couldn't even get television. So yay. That's just an aside. Anyway, the impact of economic uncertainty, and 2024 was certainly a case in point, has, in my opinion, resulted in a slowdown of practice sales. 21 was just crazy. I had probably 16 of my clients sell that year and definitely seen a slowdown. To me, it seems like unpredictability actually breeds caution. So as a seller, I think the sellers are hesitant to sell due to the fear they won't get what their practice is worth. And the buyers, they are going to be hesitant to buy due to the uncertainty of maintaining the profitability required to make the loan payments or for them to even live. So definitely economic uncertainty has been a huge factor. Inflation. Well, it's been rampant over the last couple of years. And of course, this has resulted, I have this with my advisory meetings constantly, it's resulted in significant increases in cost of goods sold, labor, trying to keep up with labor rates, and of course, other operating expenses. So if the practices have been unable to grow their top lines and keep up, then the profits are squeezed, which of course directly impacts the practice value negatively, unfortunately. Interest rates, well, those are interesting. I mean, I've been around a while, so I realize that these interest rates really aren't that bad. But for many of the younger folks who are used to those 3-4% rates, 6 and 7 is a lot. The higher rates obviously reduce the potential individual buyer's purchasing power, which leads to fewer buyers being able to purchase or even wanting to purchase because the financing costs are higher. It also can increase the length of time it takes to sell your practice because buyers have to go through the whole financing thing and evaluate actually whether they really want to do this or not and what the impact of the purchase will be on their lives. So interest rates are pretty significant that people just don't want to be paying the larger rates that we seem to be having now, although thank goodness the interest rates have come down some. So basically interest rates, inflation, and uncertainty, if it happens over a long period of time, my fear is it could result in more corporate sales and more individuals not being able to compete with the corporate offers. So not that corporate sales are bad, but they're not for everybody. And so, the individuals may be hesitant to take the plunge because of all the uncertainty that there is. And that's kind of an unfortunate thing that's happening. So those are my thoughts.
Thanks, Kamala. Yes, I was a lender in the manufacturing and tourism industry in Canada back when interest rates were 17 and 18%. And I remember that. And, I remember people losing their businesses, but I remember some who didn't. And, I always looked at what was it they were doing differently. And, they adjusted to the circumstances, but they made a decision in their mind that was not acceptable, but there will be a new normal coming out of this. And they planned for that. And I think I kind of feel like we're in a new normal. Like it was nice when we had, I have a really I like low mortgages, but I think there's a new normal. But it's about looking at the business case, the business plan with that in mind. So emotionally, we don't get tied trying to create some false expectation that might happen, but it's not going to happen in the next 5-10 year business cycle. What if the new normal is this? Do I still have the passion to do this? And to Sang's point, then the numbers make sense, and what does the multiple look like as a result of that? So really good insight, Kim. Thank you. Sang, speaking, we're going to go back to you. And the question I have for you are, what are the most common pitfalls buyers and sellers face during the transaction process? And equally important, how can they be avoided? And you can't say, don't go ahead with the deal. That doesn't count.
So let me answer this question with actually a different question.
Sure.
So imagine you have a 4-doctor practice. 2 of the 4 doctors are owners. And let's just say, for shucks and giggles, the owners' ages are 70 and 65, right? They want to sell, right? They go to market. From their perspective, they have a 4-doctor practice. Is the buyer looking at this as a 4-doctor practice? Mm-hmm. So that's my question. So, and if they are not looking at it as a 4-doctor practice, what price is the buyer thinking of, right? Is it based on 3.5 doctors, 3 doctors, 2 doctors, right? So I guess what I'm trying to point out is there is going to be a misalignment of expectations between the buyer and the seller here. And in my mind, that's actually a common pitfall, right? And it's not to say something's wrong with the practice or anything, but it's just that the seller is expecting that they have a 4-doctor practice in the market, and the buyer is probably not looking at it as a 4-doctor practice. Maybe the other big pitfall is probably miscommunication on both sides. And usually it's not based on financials or numbers. The miscommunication is usually based on emotions, right? And that's usually because the sellers are proud of their hospital, have 100% trust in their team and their clients, and the buyers have they're a little skeptical, right? They don't have 100% trust, right? And so that lends itself, especially when, from my standpoint, most of the communication is done by email and not face-to-face. It lends itself to these miscommunication just because emotions get involved. And again, this is an area where it's like hard to quantify and hard to pinpoint, but I know it's there in so many circumstances, right? So I would say that's another major pitfall that you got to be mindful of and careful of. Probably the other major one is just time, right? Sellers and buyers almost always underestimate how much time they have. They overestimate time, and they generally mismanage it, frankly. And time is such an invaluable asset. It is something, it's really heartbreaking because when a deal can't get done, right, or it falls apart because the time is mismanaged, right? Or, as in the example, if the seller is 70 years old, right, and they have not planned ahead for their exit, they have, in essence, limited their options, right? And you can't get back that time, right? Those are the top pitfalls that come to mind. I would say you got to negotiate. Oh, I'm sorry.
I was just going to, because I wanted, a question just came up that I want to slip right in there. And it's from Heather Williams. And she says, what about the scenario where the two owners are younger and not expecting to retire post-sale?
So in that scenario, probably the watch out that I would bring to their attention is you're young, you're ready to sell, but you don't intend to walk away, right? You don't intend to go fishing for the rest of your life. You intend to be part of the practice and continue to do what you're doing, right? But the problem is after that sale, right? The very next day, right? On the day that the deal closes, the wire for the purchase price hits your account, it's one of the best days of your life, right? But the next day, you walk into your practice, and every single seller has told me this. You walk into your practice, nothing's changed. The employees are the same, signage is the same, nothing is changed. Nobody really knows, none of your clients know, and yet it is no longer your practice. You're no longer the owner, and every single day it feels different. And in my mind, that mindset is something to be prepared for because it has a tremendous effect on the day-to-day for those prior legacy owners, right? They plan to continue to be at that hospital indefinitely, but it just doesn't feel the same anymore, right? And it's a material impact, right? And if you're not prepared for it, if your mindset is not ready to make that transition, it's going to be a difficult one.
That's good. So thank you very much. I actually, a couple of years ago, a little more than that. I had a North American coaching practice, and I had coaches in different cities in Canada and the United States, and I sold it. And I remember that day when on the wire, it just caught my attention. I said, "Oh, I remember that day." And that very feeling of going in and just suddenly now I was just like, I was still involved. I still am. Yeah. But the paradigm what I discovered, the paradigm shift for me had to be about me. And before I was coaching like an owner, and still I'm a professional negotiator, mediator, and all that kind of stuff. And I had to change. So now I coach like a founder. And I get used differently. I get brought into things and I do things, and it's just a whole lot more fun. And I don't have to own the stuff. I don't have to own the day-to-day operation, but I get to be. And I think for me, it was such a simple mental shift. But once I made it, it was really easy. So just on building on your comment, I think, that there's a transition there, but if you just let your emotions drive the bus, let me know how that works out for you.
I mean, that's great advice. I mean, that's great advice. Yeah, I do think there is a path to getting to that point. But yes, immediately you're no longer the decision maker, and everything is different, right? And so, yes, there is
good and bad. Thank you, Singh. I'm going to head back to Melissa. And Melissa, the question I have for you, I think I could speak English. Melissa, what strategies can owners implement in preparation of selling their practice that will result in a successful transition?
Yeah, so, I think we were talking about what buyers can look at. I think if you flip that around and you look at the seller's piece of it, you also have to look at what buyers are looking for. Okay. So I want the key to that transition process to be what is sustainable in this practice long-term without my magic, right? Because I've worked with so many sellers that are just incredible producers, incredible charmers. They are the business, right? So you have to understand that now, if you're planning on staying on in your practice for the next 10 years, maybe, the practice being all you is good for you, right? But a lot of the goodwill in your practice is the sustainability of your revenues and your profitability after you're no longer in the practice, right? So you kind of want to look at what you can do to set your practice up to be something that is not just you, right? So your staff size. Cammie touched on it earlier, making sure that your staff compensation is where it should be, right? Because a sophisticated buyer, whether it's corporate or third party, is going to be looking at, the staffing numbers, and also, are they underpaid? And if they're underpaid, how many of these people are going to leave the second that charming owner leaves, right? So there's going to be a negative adjustment for that. So you want to make sure that everybody feels good about their job, right? You want to make sure that the pricing has kept up with the market, right? And so you're making pricing adjustments, especially in these inflationary times, as needed. And it's not going to be the new owner that has to come in and implement a giant price change, right? Because it needs to be adjusted. But that's not going to look really good to the clients of the staff, right? That the new owner came in and made those huge jumps, right? So you want to make sure you're keeping up with those things. When you look at just from the financial standpoint, I see a lot of sellers that also own the property of the business that have not been keeping up with the market as far as rent is concerned. And so in their own mind, they're looking at, one profitability level that's not going to be sustainable with a new transition, with a new owner, because they're going to adjust that rent upwards, right? So you just want to also make sure in your own head that you're keeping up on your own financials with what the market bears, okay? And then, just making sure that you're looking at the practice as far as sustainability without your special sauce, right? Have you built a business or is it just all you? And people want to buy a business, right?
Yeah, that's good. Yeah, absolutely, Melissa. I think, there's that. I always think a legacy is not a noun, it's a verb, it's dynamic, it's not static, it's something that it's a journey, not a destination. Sang would say it's hard to put a cap rate on it, but how do you translate, how do you insert your legacy into what was there before and make a business case for it moving forward? I totally see that. That's really cool. Let's go back to Kamala. And I can't get it out of my head now, Kamala. I can't call you Cammy because I'm still Kamala. I'm sorry.
It's okay.
Because I'm still thinking about Camelot But anyway, Kamala, can you explain the key components that determine a veterinary practice's value and share insights on how owners can proactively enhance their practice's valuation? Good lead in from.
Well, I've always thought that valuing practices was somewhat of an art. But to determine the value, it's really all about cash flow, profitability, and you have to take risk into account as well. Valuations are typically based on some multiple of the practice's adjusted cash flow. Typically, you start with EBITDA, and everybody always wonders, what's EBITDA? And that's earnings before interest, tax, depreciation, and amortization. Your accountant can help you figure that. You make adjustments to represent the cash flow results that the buyer would achieve. Typically, and Melissa did actually bring a couple of these up, typically the adjustments are to bring the owner's wage to market value. Sometimes they're either overpaying themselves or underpaying themselves. If the seller owns the real estate, you might need to adjust the rent to market rate. If they're charitable, there may be a lot of charity in the business that they've done, and that isn't something that maybe the new owner would do, so you'd add that back. Often professional fees like consultants or accounting are added back because that's sort of discretionary of how much you spend on those items. One-time expenses like large repairs might be added back. But the bottom line is the greater the cash flow, the higher the value. But you do have to take into account the risk. And that helps you arrive at your multiple. And again, Melissa brought these up. The volatility of profitability. So let's say in 21, you had 20% of gross revenue hitting your bottom line. But in 22, it was 5%. And then in 23, it was like 7%. And then 24, now it's going to be back to 20. That's volatile. That means that you don't know how this practice is really doing. So there's some risk, and that would affect the multiple. The other is how effectively can you transfer the clients to a new owner? If your practice is all about you, that's not a good thing. You need to have processes in place, and you need the team to come to the plate, and everybody knows everybody, not just the owner. It's not about the owner, right, Melissa? So how effectively can it be transferred? And then where is the practice? Unfortunately, that's a big deal. I talk to broker friends of mine, and if it's in Podunk, and no harm here to if you're in the state, but Podunk, Missouri versus Chicago, Illinois, where would you rather buy a practice? So whether it's rural or urban or suburban, and what the available buyers are is another huge risk factor. So one of the things that I always tell people is hire professionals. Hire a vet-specific lawyer, hire a vet-specific broker, hire a vet-specific accountant. We've been through this process, and we can advise you the best way to go. Importantly, of course, I'm a CPA, so I'm going to think your financials are really, really important. But you should have your financials in order. You should be using the AHA VMG chart of accounts. You need to clean up your balance sheet. And I'm kind of going on and on, so stop me because, of course, I'm very passionate about this. You need to clean up your balance sheet, get rid of the fixed assets that you bought in 1990 when you bought the practice. Those shouldn't still be there. Clean them up, clean them out. It can affect your tax position in a sale in a big way. Clean up your inventory. Make sure you have an accurate inventory. Clean out old receivables that are sitting on your books that shouldn't be there. Anything over 90 to 120 days that you're not going to collect, boom, out of there. And you need to understand if you have what are called off-balance sheet liabilities, like a lab agreement, work with your broker, work with your attorney so that those are all brought to the surface, because I've seen deals fall through on those. I never want to work with that lab, so I'm not going to buy you. That can happen. In the income statement, review your KPIs. Your revenue mix is really important. Are you service oriented? Are you selling at least 75% of your gross revenue is for services? If you have 60% of services and 40% of pharmacy and retail, you aren't as profitable as you could be. You're a drug pusher. So make sure that your service revenue is a good mix. Cost of sales, they should be around 20 to 24% maximum. If you're over that, you have some work to do. Labor and benefits, they should be between 40 and 45% of your gross revenue. If they're over that, you need to investigate why. Are you paying overtime? Is your scheduling messed up? Facility should be less than 9%. And bottom line is your net income needs to be at least 16 to 20%. And that's after the adjustments. One of the things that I use is called a no-low threat advisory worksheet, which was developed by the Valuation Council of Vet Partners. I just went on their website and looked for it, and I didn't see it, but I have it. So if it's something that you guys want, I'm happy to send it to you. I think my contact information will be available. That will help you figure out if you're the 16 to 20% healthy practice. So I have more, but I'm figuring that Michael might want me to.
Yeah, Emily, that you're yes, you're passionate about numbers, and there's no question about that. But that was brilliant. Yes, to the for all of our participants, we will be putting up contact information as we get to the end of the webinar for each person, so you'll be able to reach out to them. But it's almost like Heather Williams is working with me here. She threw another question up here that's beautiful. She says, if this doesn't come up, could you address the question of whether to use a broker in a sale? I wonder what you're going to say. Especially when so many corporate practices are reaching out to try and make deals one-on-one.
Heather should have asked me. Sorry, she's my client, so.
Oh. Well, Heather, I think we did. There you go. That was her comeback. I think we did. So there you go. Well, that was great. That's almost like having a pet come through across the screen. The personal touch.
Yes, you should. Either that or an attorney to make sure you're taken well care of.
Yeah. Thank you. Okay, let's say I've got a question here. One more question for you for tonight, and that's how does the role of goodwill, and we've sort of talked about some of that intrinsic aspects of cap rates, but how does the role of goodwill, particularly in client relationships and staff retention, factor into a practice's valuation and the transition process?
So I'm going to assume, or I'm not sure about this. So I'm going to assume goodwill. The intent of the question and about goodwill isn't about the accounting implications and how it's used in acquisition accounting or the purchase price allocation. It is a significant part on the back end of the sales process, right? Well, since I've already started, let me touch on it just a little bit. When the transaction closes, both parties, the buyer and the seller, have to file a tax form 8594, right? It's an allocation of purchase price, basically. So let's say you sell your practice for $1 million, right? The purchase price, enterprise value is $1 million. the buyer and the seller have to submit this tax form, and you got to allocate that $1 million into, customer relationship, trade name, non-compete, and the bulk of that, the residual value is goodwill, and it's material amount, right? In veterinary hospitals, it's easily 80% and possibly far more than that, right? So clear majority of it is going to sit in this bucket called goodwill, right? It's an intangible asset. But at the end of the day, it's boring accounting stuff. And I'm assuming the intent of the question isn't about that accounting, but rather, hey, the hospital's built goodwill with its clients, right? The owner has goodwill with his team, right? How does those things translate into the calculation of the practice value is what I thought I heard in the question. And what I would say is that actually it doesn't have that material of an impact. Goodwill plays a factor in the multiple because there is a subjective component there. And as I mentioned to you on the first question about hospital reviews, that they are important, right? And there it'll play a part, but it doesn't really directly factor into the calculation itself, right? As Kamala has suggested about all the adjustments and add-ins, right? Fair market value of the owner's compensation and the rent and all of that adjustments, right? It is a quantitative financial analysis, right? The other piece that does play a part, though, in the sales process and where owner's goodwill will generally get tested is, for example, when an announcement is made, when the owner goes, usually it's to the doctors first as a first step and then to the rest of the staff. But when the owner goes to say that I made a decision to sell, right? That's when the owner's goodwill is going to get tested, right? Depending on the level of transparency and where the team is at in terms of their expectations and what they have communicated to the owner, it's going to be a smoother process or a case where owner's goodwill is going to get tested. So yeah, I think the question was, how does it factor into the practice valuation? It doesn't factor in directly, as most people think, or if some people think that.
Thanks. Yeah, that I think you bring some clarity to that. That there is that. I think in my background has a lot to do in the hospitality field, in restaurants and hotels, and restaurant owners are constantly trying to put a ton of goodwill in the well, we're just known for our food. We're known for this and which is great. But it's tough to put that into until that chef leaves and the new guy comes in. We don't know if it's going to transfer. And I love the way you just summarized that as far as that there is an integrity and trust as part of this, but it's just that the value is more in the process of the transition rather than in the multiple, is what I heard.
So let me add what I understood from what you just said here. I do believe in the example of hospitality, that example is valid and important, right? But from a strictly analytical standpoint, the goodwill that you're building up in the service industry or in a vet hospital, right? It needs to translate over in terms of revenue, profit, growth. Those goodwills need to transform over into those tangible items right there, right? Yep. And maybe I'll just use this part of my explanation to segue into a question I floated up in LinkedIn and say that revenue, in my mind, that revenue growth is more important than the profitability or or the cash flow, as Kamala stated too. In my mind, you can have two like hospitals, right? And one hospital A has high cash flow and hospital A has a lower cash flow. But if the lower cash flow has substantial, sustainable revenue growth, in my mind, I would be far more excited about that second hospital than the first. Right? I'm sorry, I segued because I floated that there's this question I was going to answer and I wanted to get at least one of them in. But in any case, I'll leave it there.
Thank you, Sang. Melissa, I want to come back around to you. And this is kind of we're getting close to as we wrap it. We'll be wrapping up here, folks, in a few minutes. So you'll stay with us to the end. Remember, I do have for all of our listeners tonight, our viewers, I have a gift for you tonight that it doesn't have any strings attached. It's not a gimmick. So trust me. That's always a dangerous thing to say, right? Melissa, what's the difference in selling to a corporation versus an associate versus a third-party independent buyer? Well, I'm curious about that one myself.
Yeah, so right now in today's marketplace, from a sales perspective, you do have those three options, right? I think it's really important to understand how much the landscape has changed in the last couple of years. We were seeing crazy multiples from the private equity corporate buyers a few years ago. Those have changed dramatically. There's significantly less money in those markets. There's less competition, just less, I think there was over 100 consolidators a few years ago. And now I think we're down to certainly under 50. I think there's probably 20 that are very active, right? And they're scrutinizing numbers like never before. But we're seeing multiples on the independent GP side, small animal, probably between 9 and 12, those types of multiples. So if we just look at pricing, that's gone down significantly there. We're still seeing from independent buyers, we're still seeing anywhere between 3 and 5. I know some valuators saying, Cami, I don't know what you guys are doing. I've seen 6s. I don't personally agree with that on the independent platforms, but I typically see a really great practice capping out at about a 5 on the independent level. But the big difference I think that we're seeing in an independent sale versus a corporate sale is the fact that we used to see a lot of all cash offers on the corporate side. You're basically not seeing that at all. So it's a combination of equity in the top co for corporate sales. You're not seeing, full cash out. You're seeing a lot of JV structures. However, on the independent side, I've seen a lot of success with banks lending up to 100% on up to $10 million in transactions, as long as the practice is viable and the buyer looks good. So from an all cash perspective, you're positioned just as well selling independently as you are to a corporation, and there's less strings attached because typically the independent buyers aren't going to require that you stay on for that 3 to 5 year period of time, right? Now it's great if you want to, and that's fantastic. But you have a little bit more leverage when you sell independently. And also, an independent sale, they're looking at, your practice's location, and you're looking at, I see doctors buying solo practices that don't have a lot of cash flow, but they get to ride their bike to work every day, right? So I think that there's going to be a lot more desirability in practices that corporations would not be interested in on the independent market. Now, when you sell to your associate internally, you're gonna have an easier transition, right? Because they already know everything about the practice. They're probably gonna require you to stay on even less period of time. From a transition perspective, it's seamless. The banks love it. The banks love to finance associates buying the practice they've been in for a handful of years. And then, both a third party independent sale and an associate transaction, those guys, if you own real estate, they're going to be the future buyers of your real property, right? Usually the corporations aren't interested in that, right? So, when you look at selling corporately or to an independent buyer, I think that there's a lot more than just price to look at, right? It's what your real needs are. And if you need all that cash, I don't think that you're very far off selling to an independent versus a corporation. But, every transaction is different.
Thank you, Melissa. And thank you, all of you. As we're wrapping up, I just, Richard, the question you said, what is a JV structure? A JV structure is a joint venture structure where you're not just leaving the business completely. That's what I ended up doing, was a joint venture where I still am still involved in my company, but I have no ownership at all, and it's a joint venture. But I'm going to just change gears. You guys rocked it. That was awesome. So please, a reminder to like, share, and review us on your favorite social media and be a part of someone else's success too. And until next time, keep striving for excellence and making a positive impact in the lives of your patients and pet parents. Michael Walker signing off, and thank you on behalf of all of our panel experts.